Make no mistake, volume is the missing puzzle piece that completes the picture of chart patterns, the secret weapon in your trading arsenal. So starting today, no more guessing or relying on luck. Now, when applying volume spread analysis, there are two important factors to consider. First, you look for validation between price and volume. And second, you look for any disagreements between them. Validation occurs when any price movement is supported or confirmed by the corresponding volume activity. On the other hand, if there is a disagreement between price and volume, it signals a potential change in the market. So if the price is rising, but the volume is decreasing or not keeping pace, it may indicate a weakening of the trend and a possible reversal in the near future. Validation and divergence are the key concepts in VSA. Traders using VSA are not just looking at price action after it already happened. They also analyze volume in real time to anticipate future chart patterns. By understanding whether the volume supports or diverges from the price movement, you will better anticipate the market's potential for continuation or reversal. Now, there are numerous patterns that traders use to analyze the market, but we won't talk about triangles, wedges, flags, or other ineffective retail junk. No, we will analyze the patterns that have proven to be highly effective and occur frequently. Some of the patterns are retail, but some of them are related to smart money concepts. The first one is the trend continuation pattern, or if you study ICT, the break of structure pattern, the BOS. In a bullish trend continuation pattern, we observe a series of upward movements and corrective pullbacks. The highest points in the price are higher than the previous highest points, and the lowest points in the price are also higher than the previous lowest points. This pattern indicates a continuation of bullish momentum, as buyers push the price to new higher levels, showing a sustained upward trend. When a market is moving up, it needs buying pressure to sustain the upward movement. This buying is typically seen when the present bar closes higher than the previous bar, and it's important to pay attention to the volume of the up bar. The volume should be increasing, but not excessively. Excessive volume may indicate that there is more supply in the market, in the background. If you notice that the volume is low as the market moves up, it's a false indication. The low volume suggests that smart money, who have significant influence, are not participating in the upward movement because they perceive the market as weak. And without the involvement of this smart money, the market is unlikely to rise significantly in the future. In a bearish trend continuation pattern, we see a series of downward movements and corrective pullbacks. The highest points in the price are lower than the previous highest points, and the lowest points in the price are lower than the previous lowest points. This pattern signifies a continuation of bearish momentum, as sellers drive the price to new lower levels, indicating a sustained downward trend. During this pattern, you may see temporary upward movements on low volume. This implies that professional traders are not interested in higher prices and are not actively participating. A legitimate downward movement requires evidence of selling pressure, which is reflected in increased volume on down bars when the present candle closes lower than the previous candle. However, if the volume increase is excessive, it's a warning sign that there may be demand in the background. If you notice the volume drying up on down bars, it indicates a reduction in selling pressure. The market may continue to fall, but be aware that it could quickly reverse and rise momentarily due to the lack of supply. Decreasing volume on down bars suggests that there is no significant professional interest in further downside movement. The next pattern is the double top, which contains a liquidity run. In a double top pattern, we start with an upward trend. The price reaches two similar highs, creating a resistance level. The swing low between the highs is known as the neckline. This pattern suggests a loss of momentum in the previous uptrend, indicating a weakening of buyer interest. Basically, the two high points represent unsuccessful attempts by buyers to push the price higher. When the price falls below this neckline, it confirms the double top pattern. Now, I have more confidence to trade this pattern if it includes a liquidity run on the second high point. It's quite common to see the market clearing the double top with a spike, triggering stop losses before moving in the intended direction. During the formation of the first high, volume can provide valuable insights. If the volume is high, it suggests strong buying interest. At this point, you don't know if a double top is forming. It's just a simple break of structure pattern. However, if the volume is low, it could indicate a lack of conviction from buyers. After the first high, there is usually a pullback phase where the price retraces slightly. During this phase, a decrease in volume is common, indicating a decrease in buying pressure. As the price climbs towards the second high, observe the volume again. If the volume is lower than during the formation of the first high, it could indicate diminishing buying interest and potential exhaustion of the uptrend. It suggests that fewer traders are willing to buy at higher prices. This volume decline acts as a warning sign, suggesting a weakening trend. The liquidity run on low volume is another sign that something is suspect. The most critical phase of the double top formation is when the price breaks below the neckline. Here, volume plays a vital role in confirming the pattern. If the price falls below the neckline on high volume, it suggests a strong shift in sentiment, with sellers taking control. High volume during the breakdown adds credibility to the pattern and increases the likelihood of a trend reversal. In a double bottom pattern containing a liquidity run, we start with a bearish trend continuation pattern, a bearish BOS. The price reaches to approximately equal lows, creating a support level. Again, I like to see a liquidity run on the second low, taking stops and trapping traders on the short side. The swing high between the lows forms the neckline. This pattern suggests a loss of momentum in the previous downtrend, indicating a weakening of sellers' interest and a potential trend reversal. The two low points represent unsuccessful attempts by sellers to push the price lower. When the price rises above this neckline, it confirms the double bottom pattern. When the price reaches the first low point, pay attention to the volume. If the volume is high, it suggests strong selling interest. But if the volume is low, it could indicate a lack of conviction from sellers. After the first low, there is usually a pullback phase where the price retraces. During this phase, a decrease in volume is common, indicating a decrease in selling pressure. During the formation of the second low point, look at the volume. If the volume is lower than during the formation of the first low point, it could suggest diminishing selling interest and potential exhaustion of the downtrend. This volume decline acts as a warning sign, indicating a possible trend reversal. The liquidity run should ideally occur on low volume. The most critical phase of the double bottom pattern is when the price breaks above the neckline. Here, volume provides the confirmation you need. If the price rises above the neckline on higher volume compared to the previous low point, it suggests a strong shift in sentiment, with buyers taking control. Now let's briefly discuss how you can incorporate these patterns into your trading strategy. There are 4 main variations to consider. First is the neckline breakout entry. In a double top pattern, once the price breaks below the neckline and makes a new lower low, it confirms a reversal and a change in trend direction. In a double bottom pattern, once the price breaks above the neckline and makes a higher high, it confirms the reversal and a possible change in trend direction. The second aspect is the pattern formation at a key level. Identifying a key level of supply or demand is crucial. If a double bottom pattern forms at the demand area, or a double top pattern forms at the supply area, it strengthens the pattern's significance. My favorite entry is the pullback into a recent supply or demand area. Instead of entering a trade immediately after a breakout, you may prefer to wait for a pullback to a lower timeframe supply or demand area. This provides an opportunity to enter the trade at a better price. and you don't blindly chase the breakout. Consider candlestick patterns at these key levels. Combining candlestick patterns with double top or double bottom patterns can provide additional confirmation. Look for candlestick reactions at the moment of the neckline breakout, or at the pullback to a supply or demand zone, pin bars and engulfing bars in particular. For example, a double top pattern forming with a long weak candle at a resistance level can confirm a trend change from an uptrend to a downtrend, or an engulfing candle after the price tests the neckline after the breakout is another good sign. A trend change pattern, also known as a change of character, occurs when the price breaks a significant swing high or low for the first time. This signals a potential shift in the market's order flow. For instance, if the market has been in a downtrend with lower lows and lower highs, and the price breaks above a previous major swing high, it indicates a change of character. From a price action standpoint, these patterns show a loss of momentum from sellers. Instead of continuing to make lower lows, the price creates a reversal pattern. Buyers are gaining control, suggesting a trend change from a downtrend to an uptrend. During the formation of the lowest low, keep an eye on the volume. If the volume is lower compared to the previous swing low, it could suggest diminishing selling interest and potential exhaustion of the downtrend. This volume decline is the first warning sign. The most critical phase is when price breaks above the previous major swing high. If the price rises above this level on higher volume compared to the previous swing low, it confirms the shift in sentiment, with buyers taking control. Conversely, in an uptrend, with higher highs and higher lows, when a price breaks below a significant level, it forms a new lower low, indicating a potential trend reversal. From a price action perspective, this pattern indicates a loss of momentum from the buyers. Instead of continuing to make new higher highs, the price creates a reversal pattern, suggesting a potential shift in order flow. After a minor pullback, if the price continues to create lower lows and lower highs, it indicates a new bearish trend. If the volume during this high point is lower than the volume during the previous swing high, it indicates a decrease in buying interest and the possible exhaustion of the uptrend. This decline in volume serves as an initial warning sign. You don't know yet if a reversal is on the cards. However, the most crucial phase is when the price breaks below this previous major swing low. If the price breaks this level and does so on higher volume compared to the volume during the previous swing high, it confirms the shift in the market sentiment. Buyers have taken control, further supporting the potential trend reversal. The head and shoulders pattern, although a retail one, is a decent one to monitor, as it marks the transition point between an uptrend and a downtrend, with the left side representing the end of the uptrend and the right side representing the beginning of the downtrend. The pattern starts as a series of higher highs and higher lows. That sequence is altered when a low point is formed that has the same approximate values as the previous low. If it contains a liquidity run, it's even better. The price rallies from this low point, but instead of resuming the sequence of higher highs, a lower high occurs. Then the price slides back to the previous low for a third time. If a higher high occurs on expanding volume, this is considered healthy and normal in an uptrend. However, in an ideal scenario, the head and shoulders pattern sees volume diminish on each successive high. The higher high that forms the highest point of the head should ideally occur on lower volume than the previous high, which formed the left shoulder. Volume should diminish further on the third high as the right shoulder forms. This demonstrates a lack of enthusiasm from the buyers, who are losing their will to continue buying at higher prices. If and when the neckline breaks, that break should occur on high volume. Observe how volume decreased as the pattern formed. The volume under the head is low compared to the rally that preceded it. In fact, volume is extremely low on this bounce from the neckline. Once the neckline was broken, volume began to increase as the price moved lower. In fact, it started to increase prior to the breakout, which confirms the selling pressure. This also works if it's not a head and shoulders. Maybe you have a triple top, which includes a liquidity run. The neckline is the focal point if you wish to use this pattern to your advantage. This is the area where many buyers remain trapped with losing positions. Since the price moved up from the neckline on several occasions, we can assume that many traders were buying at that level. We know that those buyers, along with any buyers who entered at higher levels and are still in the trade, will be holding losing positions if the neckline should break. These losing traders will be forced to sell, which should help push the price lower. Also, aggressive traders will close long positions and start to sell as the price breaks through the neckline. This adds momentum, and during this phase, you must see increasing volume. The double liquidity run pattern, also known as the master pattern, is another common smart money formation. It's a trap to attract both buyers and sellers to take losing positions. First, price breaks a swing high, but then it quickly reverses, deceiving all buyers who took the bait of the breakout. Amateurs will enter what looks like an obvious breakout. Then the professionals will push the market back the other way. This is the first liquidity run. The second part of the pattern consists in another trap. Price will decrease and will break a swing low this time, and trapping sellers on the wrong side. This is the second liquidity run, designed to trap the weak hands in the market. Very hard to make money as a retail trader if you don't know what you're doing. If you analyze this pattern, you'll observe it contains three market phases: contraction, expansion, and trend. Firstly, we have the contraction phase. This is when the market is setting up. The contraction phase occurs on low institutional trading volume, resulting in mostly sideways movement. It's not an ideal phase for trading, but a part of retail traders are taking the bait, hoping to catch a breakout. You'll often see this phase during the Tokyo session. Secondly, we have the expansion phase. This seems like an exciting phase for retail traders. Expansion is characterized by a minor increase in trading volume. The market becomes more active, breaking previous highs and lows. Smart money takes advantage of this phase to accumulate positions at discounted prices, while inexperienced traders often get caught in the whipsaw movements. It can be a challenging phase because market breaks on both sides of the range, trapping most retail traders. Finally, we have the trend phase. This is the phase where the market makes a significant and aggressive move in one direction, with increasing volume. During this phase, institutional traders use the market's liquidity to exit their previously accumulated positions. These three phases complete one market cycle. Once they've played out, you can expect the market to go through these phases once again. One more example. During the contraction phase, you'll see periods of sideways movements. You'll notice low institutional volume. As a beginner, it's wise to avoid the contraction phase. Then we have the expansion phase, the double manipulation, with two liquidity runs. First, a breakout below the range. As soon as they see the market breaking down, retail traders start selling, believing it will continue to decline. Then, later, when they see the market breaking up, they start buying, assuming it will rise further. However, what they fail to understand is that smart money operates differently. They sell when the price is above average and buy when it's below average. If you look at the volume at the time of the fake breakouts, you'll see that it's low. Lastly, we have the trend phase, where we see the price move significantly, and you'll notice a volume increase during this phase. You cannot control when or how these phases occur, but if you try to understand them, you can improve your trading approach and have a better grasp of the market dynamics. Now let's go deeper with some advanced smart money patterns. First is the accumulation one. Accumulation is nothing but a sideways market activity that happens after an extended downtrend. This is the phase where smart money try to acquire positions without moving the prices too much to the upside. So let me explain wyckoff events during accumulation. First we have the preliminary support. This is when a lot of buying starts happening after a long period of prices going down. The volume increases, and the difference between the highest and the lowest prices widens. Then we have the selling climax. This is the point where the selling pressure reaches its peak, and the difference between the highest and the lowest prices widens even more. Retail traders continue to sell, but smart money start buying at or near the bottom. Then we have the automatic rally. After the intense selling pressure decreases, there is a wave of buying that easily pushes the prices up. This rally helps us define the upper boundary of the trading range during the accumulation. Next is the secondary test. The price revisits the level of the selling climax to see if there is a balance between supply and demand at that level. For a bottom to be confirmed, the volume should be significantly lower as the market approaches the support level around the selling climax area. And it's common to have multiple secondary tests after a selling climax. And then we have the sign of strength. This happens when the price goes up with increasing price difference and relatively higher trading volume. A sign of strength often occurs after a spring, which is a fake breakout, a liquidity run, trapping retail traders on the short side. A spring is when the price falls below its usual range and then quickly jumps back up into that range. And then we have the last point of support. This is the lowest point during a pullback after a sign of strength. It marks the final push toward the bottom of the accumulation phase before the upward trend begins. The last point of support creates a higher low, and then the price starts going up again aggressively. Now let's analyze the different phases of an accumulation, taking into account the volume. First is the phase A. This is where the sellers have been dominant until now. We see a decrease in supply during the preliminary support and the selling climax. These events are usually obvious on the charts, with wider price differences and high trading volume. In phase B, smart money start buying at relatively low prices in anticipation of the next increase. The price swings are wide with high trading volume, but as smart traders absorb the available supply, the volume during downward swings within the trading range tends to decrease. In phase C, the price goes through a decisive test of the remaining supply to determine if it's ready for an increase. It's like a trap for those who sold. A successful test of supply with a spring provides a good opportunity to initiate a long position. In phase D, demand starts dominating supply consistently. We see a pattern of price advances, signs of strength, with wider price differences and increasing trading volume. There is also a last point of support with smaller price differences and lower trading volume. And finally, we have phase E. This is when the price leaves the trading range and demand takes full control, leading to an obvious increase. New trading ranges can also occur, known as reaccumulation by smart money. These ranges are like stepping stones toward even higher price targets. Let's also talk about wyckoff events during distribution. First is the preliminary supply. This is when smart money starts selling after prices have been going up. The trading volume increases, and the difference between the highest and the lowest prices widens. This suggests that the trend might be changing. Next, we have the buying climax. During a buying climax, there is a peak in buying activity with higher price differences. A buying climax often marks a top in the market. Next is the automatic reaction. After the buying climax, the intense buying pressure decreases and the sell-off occurs. This reaction helps define the lower boundary of the distribution trading range. Next is the secondary test. The price revisits the level of the buying climax to test the balance between supply and demand. So the trading volume and price differences should decrease as the price approaches the resistance level of the buying climax. Sometimes, a secondary test takes the form of an upthrust, a liquidity run, where the price briefly moves above the resistance level before quickly reversing back below it. Next is the sign of weakness. This is observed as a downward move to or slightly below the lower boundary of the trading range. It usually happens with increased price differences and increased volume. The automatic reaction and the sign of weakness indicate that supply is now dominant in the market. And finally, we have the last point of supply. After testing support on a sign of weakness, there may be a rally with narrow price differences. The market struggles to advance during this rally, indicating a weak demand. Now let's look at the phases of distribution. In phase A, the prior uptrend stops and the supply starts entering the market. We see preliminary supply and the buying climax, followed by an automatic reaction and a secondary test of the buying climax. In phase B, smart money initiates short positions in anticipation of the next decline. Signs of weakness are often followed by significant downward price movements and increased trading volume. Phase C is an interesting phase. This is where upthrusts may occur. Price moves above the trading range and then sharply reverses back down. Many retail traders fall into the trap of going long during this phase. In phase D, signs of demand decrease and the price may break the trading range support or decline below the midpoint of the range. It's a good time to go short at the last point of supply. It's also the last opportunity for long position holders to close their positions and go short. In phase E, which is the final phase of distribution, supply is in control and price breaks below the trading range support. The high volume supply breakout pattern is one of my personal edges. When smart money push up through a potential area of supply, which is known as a resistance level, they face a challenge. Many traders who bought within that area are still holding their positions and want to sell to recover their investments. These traders represent potential supply, meaning they can act as a resistance to the market's upward movement. If market makers are expecting higher prices and want a rally, they need to avoid being forced to buy from these traders at what may seem like high prices. So they use a strategy called gapping, which means quickly and significantly pushing the price up through the supply zone. By the way, I learned this from Tom Williams' book, Master the Markets, a must-read if you want to learn more about this. This momentum candle, on high volume, discourages the trapped traders from selling, as the market approaches the point where these sellers can sell without a loss. The price suddenly shoots up, often creating a gap on the chart. This gives these traders a profit and reduces their inclination to sell. Gapping up through supply on high volume is a tactic used by smart money to limit the amount they need to buy to sustain the rally. It helps them avoid buying at high prices. When high volume follows these wide spreads, it indicates that professional traders were willing to absorb the selling from the trapped traders who did decide to sell. And this is known as absorption volume. This breakout triggers a new wave of buying, as traders who shorted the market need to cover their positions, and others looking for breakouts also enter the market. Traders who were not previously participating may feel they are missing out and start buying as well. All these factors contribute to the professional trader's bullish positions. If you see any testing or down bars on low volume after the gapping event, it is considered a strong buy signal. This suggests that the market is likely to continue its upward trend after the initial breakout.